Hello again. This is the review for the final exam covering Chapter 22, Budgetary Control and Responsibility Accounting. So in this chapter we continued our discussion of budgets, static and flexible budgets. Uh, you should understand what those are and the purposes of each. Understand the concept of management by exception as we started to look for differences and how significant those are. Uh, Understand cost centers, profit centers, and investment centers, what they are and the responsibilities of each type, what the manager's responsibilities are for each of those. The concept of controllable margin and how to compute it with information given. Understand the concept of return on investment, or ROI, and how to compute it using the controllable margin. And understand what budget reports are, what goes into them, and how managers and management use them. So with that, we're going to look at a review problem, problem 22-1A, found on page 1177, and this illustrates a flexible budget and a budget report for manufacturing overhead. So we're given a bunch of information here regarding variable overhead costs and fixed overhead costs. And what they're asking you to do in part A is to prepare a monthly flexible overhead budget for each increment of manufacturing direct labor hours of production, going from 27,000 to 36,000 actually in 3,000 hour increments. So what you need to be able to do, of course, is work with the information given to develop that budget at each of these direct labor hour levels. So the first thing you need to do is determine what is the variable cost per hour in this case for each of these variable costs down the line. And we're going to look at those calculations in just a minute. Once you do that, you have the basis to multiply that cost per hour times the number of hours, and then you can get the total cost per month for each of these variable costs at each level of production. Once you have that unit cost per hour, then you can determine what the total variable cost should be at each of these levels. So that's the beauty of a flexible budget. So the solution here, we've gone through and made all those calculations for all of these variable costs. There are 5 of them, going from indirect labor and indirect materials, repairs, utilities, to lubricants. So again, these are all manufacturing overhead costs. You would expect them to be indirect in nature, but they are based, the estimates for them are based, of course, on the direct labor hours that would be anticipated to be incurred. Now, on the fixed cost end of it, we're given a bunch of annual fixed costs. So really all we need to do with these is to take each one and divide it by 12, and there's your monthly cost. And since they're fixed, they're not going to change over the relevant range of production, which we can assume this entire range here is relevant. It's all potentially expected or achievable. So we're just going to carry all those fixed costs. There's 5 of them: supervision, depreciation, insurance, rent, and property taxes, and just carry them over to each level. So that will add 20,000 to the total costs at each level of production. And finally, the total costs will range from 52,400 at a 27,000 hour level all the way up to 63,200 at a 36,000 hour level. Okay, so that's the actual budget itself, the flexible budget for manufacturing overhead for this company. Now let's take a quick look at how the variable costs were determined. And again, with the indirect labor, we were given a total annual 126,000 of costs for this item for indirect labor. We were given that there were going to be a total of 300,000 direct labor hours. So we simply take the 126,000, divide by the 300,000 hours, we get 42 cents an hour. For the indirect materials, it's the same thing. There was 90,000 given in the problem. We divide that by our 300,000 hours, we get 30 cents an hour. Repairs, same thing. We were given 54,000 total variable costs for the year. Divide by 300,000 hours, direct labor hours, 18 cents an hour. Utilities, this was estimated at 72,000 for the year, divided by the 300,000 direct labor hours, 24 cents an hour. And lubricants, finally, 18,000 divided by the 300,000, or 6 cents an hour. So you just need to do the math properly for all these. And then in our solution here, the total variable cost, when you add all those up, I didn't put it here, but is $1.20. So it was a fairly round figure when you added all these variable cost figures up. So if you wanted the total variable cost for a month, you could simply take that direct labor hours for the month times that $1.20 to get the total variable costs for that month, instead of each individual item. So now on the fixed costs, again, it was just taking the annual cost that you were given and dividing it by 12. So that gives you a total for each month. It's not going to change. So the example here, supervision, 96,000 was given for the year. Divide by 12, 8,000 per month. Just do the same thing with the rest of the fixed cost items. And finally, they asked in Part B for a manufacturing overhead flexible budget report. So this is the report of actuals versus budget, whereas before we were just asked to prepare the budget itself. Now, when you look at, I'm going to do something here to try to take some of that glare out of there. When you look at the budget at 27,000 direct labor hours, and that's what we're going to do because we are told that they actually expended 27,000 direct labor hours for the month. So we already know what our variable and fixed costs are at 27,000 direct labor hours because we went through that exercise with the budget. So we can simply carry those figures over from that 27,000 hour level as our budgeted amount, to which we compare the actuals, which were given to us and shown in that actual column. Now, to then subtract, we take the budgeted amount, subtract the actual amount, and if it's negative, then it's unfavorable. The first item here, for example, indirect labor, came in at 12,432, which is 1092 over the budget, so that's an unfavorable difference. With materials, that came in 7680, or 420 less than budget, so that's a favorable difference. Repairs came in just $60 less, but that's a favorable. And utilities came in at 360 more, 6840 versus 6480. And that's an example there where you really need to watch out for transposing numbers. So that's 360 unfavorable. We add all those up, we get a total unfavorable difference on the variable cost side of 1272. Now on the fixed cost side, you wouldn't necessarily expect to see any differences, but it turns out that with insurance, we had an actual cost of only $2460 versus $2500. So we had a $40 favorable difference there. And so when we come down to the bottom line, we had an unfavorable of 1232 in total for the month, based on 53,632 actual versus 52,400 the budgeted total. And that's problem 22-1A.